the RBA says, the RBA report says that pension assets are worth around 1.2 trillion. So you can see that's close to 80% of the pension assets in the country. And then the key thing to note about this survey, we do only concentrate on the segregated mandates. We don't capture the deposit administration investment that are done with insurance firms. So I'll take you through the presentation, just touching on the traditional asset classes that have been there. The fixed income, with this largely comprises of the government bonds, where the government borrows from us and then on a periodic basis gives us coupons in the form of interest, and also at the end of that term they give us back whatever we had loaned them back, and also the last coupon. And also the other space is the local equities listed at the Nairobi Securities Exchange. This sector hasn't grown that much. It has had issues. We know the interest rate cap that has been there, that has affected the performance of the banking shares in this space. And also we have not seen much listing for a while. There has been a plague of lack of listings of new shares. And you have also seen some shares being delisted from the exchange. We saw Kenol Kobil, and you have also seen others being bought out. We saw KCB buying off National Bank shares. So not much has grown in this space. That it has had its own challenges, and you have seen even how our pension schemes invest in this space has been reducing over time, considering the risk element that is there when you invest in listed equities. Just before I go to the returns of the various categorization, let me talk you through what we have noticed in the market, that most of the pension schemes that have shifted towards a less conservative, less aggressive approach, so they have the aggressive towards the conservative allocation. This has also been brought about because of we know our equity market has not been doing well over the last couple of years. So we have seen the lower valuation has resulted in schemes having lower holdings in the equity space, and we have also seen some schemes having a higher preference towards fixed income return, because over the last 5 years, fixed income asset class has been generating double-digit returns. So we have seen more schemes digress towards that space. Hence, you have seen over a trend of period from quarter one to the latest quarter, you have seen the number of schemes invested in aggressive manner decreasing, while the schemes that invested in a conservative manner increasing because of the chasing the higher returns that are being posted by the fixed income asset class, which is a less risky asset class.
They will always pay you back, but what is that money worth? Right? So there's an element of inflation. If there's too much money that's just being printed and in the supply just so that we can pay back, inflation levels become so high that money, although you have it back, is not actually worth what you would want it or what you would expect it to be worth. So especially when it comes to pensions, when we're looking at such a long period of time, we're looking at 30 years, in some cases 40 years, inflation has a very, very big role to play. That's why we also highlighted that at least the returns we're looking at for all periods, I think 1 year, 3 year and 5 year, the average return from pension schemes for all the periods has beaten inflation quite comfortably, actually. A margin of a good 3% above, at least for the 12 months and 3 years. So that's why we keep tabs on inflation.
Conservative schemes, you can see, have superior returns over that period to aggressive schemes. So what that means is that investors have not been rewarded sufficiently for that risk. But that doesn't mean it will always stay like that. Okay, we go through periods like that. We go through periods where the equities will provide those superior returns, and we expect that to come through, and then aggressive schemes will outperform. But more importantly than that, I think one thing that really sticks out to me, and I hope you see that too, is we have ups and downs. Okay, for example, last year, 2018, members of pension schemes did not receive a very high return. It was a small positive return, but it was a single-digit return. And we do have volatility where some years schemes may provide members with above 20% returns, and other years they may provide returns below 5%. Okay, so there is that volatility. However, if you look at these numbers, even on a 5-year basis, those returns are very strong, earning about 10% net of all your costs. Okay, net of all the costs of operating the scheme, earning 10% when inflation is below 6 means you're doing pretty well. So I think that's also something important for members to understand, that despite the volatility, it's important to maintain long-term views. And if you look at those numbers on a long-term basis, despite it being a poor period, what we've considered a poor period, those returns are still pretty good.